Welcome everyone to the Daniel Krug and Associates Wealth Management Review for September 16th, 2021. Today's presentation is titled Still on the Rise. My name is Rocky Isfan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel Krug will be joining me in this presentation. Just a reminder that this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. We want to thank CNR's City National Rockdale and AssetMark for their contributions for today's information. Our agenda for today, we're going to be going over what the economic outlook looks like here in the third quarter going into fourth quarter of 2021. We're going to take a deeper dive into a couple little sectors that are current events kind of going on and what's happening in the housing market. Also, we're going to close with the opportunities that are available to us moving forward.
Well, hello everyone.
Good to see you guys. Thanks for joining us.
We are back, ready to go. We got some exciting stuff to talk about here, and I think it's going to be beneficial for you. So
taking a little different tack today, we're going to be going over the big picture, what's going on in the economy, looking at a couple things in a little deeper dive, like we said, and then really talking about what we see as the opportunities for your investments moving forward through this year and going into next year.
Absolutely. So let's go ahead and get started here. Okay, so I get to start it today. We're going to talk a little bit about the economy. Most of our clients have seen these economic indicators. They're put out by City National Rockdale, and they put them out on a monthly basis. It gives advisors and clients the ability to kind of gauge where the economy and the markets are going. And what I want to point out here is these indicators that I'm showing right now really are for March of 2020. So these are the economic indicators from really a little over, well, a year and a half now, back when we started to shut down our economy. And it was reflected not only in the economy, but the market. So I want to refresh you a little bit on how these dials work. As you can imagine, green is good, yellow is neutral, and red, well, that's a bit on the negative side. In each one of those dials, you have two hands. You know, one's gray and one's black. Black is where we are today. Gray is where it was the prior month. So you can see that almost all the indicators went the wrong direction between February and March, as indicated by this chart. It was a really rough time. I'm sure everybody remembers it. Let's go ahead and fast forward to the beginning of this year. We had a pretty quick dip in the market and then a bounce back. We had what they call a K recovery. You know, pretty much no one heard of what a K recovery was until midway into last year. And the K recovery effectively says the market went straight down, and then half of the market went up, the other half kind of stayed the same, just kind of walked sideways. So you had a dichotomy going on there. But you fast forward again to 2021, and you're seeing that there is a lot of change, and it's green is the prominent with yellow right behind it, and then a couple reds. So looking at the aggregate, we were looking pretty good in January. Let's go on to today, and this may surprise everybody. I know it surprised me, Rocky, when I was looking at this, because I have never in the history of these charts seen such a green chart. I mean, we've got 17 indicators that are green and 3 that are yellow. And quite frankly, I've never seen the political environment and the geopolitical risk yellow before. So things are really kind of changing out there for the positive based on the economy and the market. Life's looking pretty good. This kind of sums it up right here. you look at March of 2020, there was 12 negative dials, 3 neutral and 5 green. You fast forward again to September of 2021, there's 0 negative, 3 neutral, and 17 green. So we're in really, really good shape. And this is why we're very optimistic about where the economy is going and where the market still is leading us to moving forward.
Well, 18 months later, and it looks pretty good. I think one of the biggest concerns out there is the economy overinflated? Is it somehow in a bubble? Is the market in a bubble? Is the economy in a bubble? And we're going to talk a little bit about that in the next few slides on comparing kind of where we are today, feeling that everything's high, versus where we were way back in 2008 when the market actually did crash and the economy did go slide into recession for the next 15 to 18 months. So I think we should move on and kind of go a deeper dive into some of those indicators and what we're seeing.
Absolutely. So, where a lot of people are concerned about the bubble and everything's going to kind of fall back down again, I think what you're going to see in this presentation, Rocky, is that might not be the case. We might be in much better shape than most people think. And there's a lot of statistics and the charts we will bring out that will kind of show you that.
Okay, so we're going to take a little deeper dive of where we're at right now in a couple of those sectors that we talked about. Just keep in mind that the leading economic indicators Dan was talking about is trying to forecast the next 6 to 9 months out. But I want to start with this because it did have an impact and it did change the forecasting a little bit going into the 3rd and 4th quarter of this year. We did have a major storm move through, the Hurricane Ida that turned into a tropical storm and moved through the country, the east part of the country. Ida had a huge impact. In fact, when you look at it relative to past major storms, you can see here Katrina, Maria, Sandy, Harvey, and Ida comes in here at about number 7 in impact to the economy. So it was pretty significant. They're estimating it's about a 0.2 to 0.3% hit to the 3rd quarter GDP. So those numbers from where we were talking about, and Dan's going to go over them in a little bit, have been revised down a little bit. And this is part of the reason. So we don't want to lose sight of, major storms. These aren't the black swan kind of things, Dan, that we talk about that you can't forecast. A major storm having a huge economic impact like this, but this was a big deal. So that is playing into the numbers. The next thing I wanted to look at a little bit deeper was the jobs and unemployment. And I thought this is a super chart that was put together by City National Rockdale and just recently updated. So you can see on here, we're going all the way back to 2005 and looking at unemployed workers, which is the blue line, and job openings, which is the black line. And you look at the recession, the gray area there, between 2005 and 2010, what had happened? Huge unemployment and a loss of jobs. And that gap was really, really wide. And now you look at actually what's going on today in 2021, we actually had this chart invert on us, and it hadn't done that in a long time. It did a little bit in 2018, but it's also happening again coming out of COVID. We actually have today more jobs than we have workers. We've got 10.9 million at the end of July job openings versus going into August, the early August numbers are about 8.4 million unemployed. So that is a concern in getting people back to work and filling these jobs. Obviously, we've got the Delta variant. We've got things going on that are kind of constricting some of this. But from a unemployment standpoint, that's a good sign, is that at least there's jobs out there that as we're trying to reopen the economy, keeping things moving forward, that people will be able to find work. Another thing this addresses and why the numbers inverted was there was a lot of stimulus money out there. People were being paid not to work. That ended in September. So we're believing, looking at this moving forward, that we're going to see more people out there taking some of these positions, and the unemployment will continue to go down.
Well, that from an economic standpoint bodes well for us then,
Yeah.
right, Rock?
That's part of the, playing into future revenues and things like that for corporations. If they can get people to work, they can start meeting the demand, because there's definitely consumer demand for products and services right now that are not being met. And I wanted to talk about housing this month, because housing is had a major role, I think, in the recovery.
Yeah.
Post-COVID, people were doing two things. They were fixing up their homes at a historically high rate, but they were also buying homes. And what you see in this chart, if we go back, and this goes all the way back to 1984, and the brownish red line represents mortgage payments as a percentage of household income. Now think about this. Back in 1984, it took 40 to 45% on average of the average household income just to pay for the mortgage.
That's a lot.
That's a lot of outlay, and it limits discretionary spending.
Yes,
Okay, the more you're paying for your mortgage, the less you have for other things. And then look at the actual median home price back in 1984. So as these lines were coming together, that was actually a sign of increased wealth growth in the United States, because what was happening, even though home prices were increasing from 1984 through 2004, all the way into 2008, the ability to afford that home was decreasing. It literally almost dropped by 15–20%. And you can see in about 2004 to 2008 that actually changed. What happened? Why did the median income percentage go up with home prices? I think it was because a lot had to do with the changes in the rules. The lending rules were changed. More people could afford a home because you didn't have to put as much down. You didn't have to have as good credit. You didn't have to have any credit.
Yeah, that was prior to the changes.
Yeah. So a lot of things happened at that point, and I think that's what actually created the housing bubble we saw. And then you see 2008, that they started to separate again. Okay, we had a little bit of a downturn. Everything peaked in 2006–7, and then we had a downturn. But then look what's happened since the recession, the Great Recession. Home prices continued to go up.
Yeah.
Okay, so the median home price was escalating quite rapidly, but obviously the wealth of the individual in the United States continued to grow with that, because the price or the percentage of money that they had to outlay monthly kept going down, which meant there was more discretionary spending, which is what continued to cause our economy to grow. I think this is a phenomenal chart to see. And now compare where we're at today, and people saying, well, are we in a housing bubble? Because housing prices are so high. Well, we don't have the same situation.
Well, that's what I find interesting, Rock, because when you're looking at this, I think, and I got to give kudos to Rock in really kind of finding this and pointing out this chart, because this is, too many people take one statistic and one chart and they build what's happening with the economy around it. But when you add what they're talking about right now with the housing prices and the fact that the home mortgage payment percent is so low relative to income, this tells you that you're not going to have a major default situation coming up here. There is a subset of homeowners out there that were taking the money from the extra stimulus and everything, And instead of saving it for paying their house when they aren't working, they spent it. So there may be a subset that you'll see out there in the news where all of a sudden there's defaults coming, and we really don't anticipate that happening for another year. But if you do hear it, it is not a bubble collapsing at that point.
Yeah. So the whole point of this is housing affordability is probably at an all-time high, even with high home prices that we're seeing coming out of the 2008-9 recession. And to further bolster that argument, and we can look at these two charts here, okay? AssetMark did a great job of putting this data together for us. The chart on the left actually breaks the group of mortgages into two groups. Group purple is the lower credit score people, and the orangish line is the high credit scores. So look back in 2004 to 2008. The same about number of people, whether you had high credit or low credit, was getting a home, was getting a mortgage.
Yeah.
Since the recession, they changed the rules and made it more difficult. They kind of went back to some of the old standards. You know, you need 28% of your income to be able to cover the mortgage, as opposed to whatever.
Yeah.
And 33% of total debt. You know, you couldn't have more than 33% total debt to take on a mortgage. So those kind of things are back in play. And look how that played out over the last several years. The number of people with high credit scores are getting the majority of these mortgages. Again, to Dan's point, the amount of defaults out there probably are going to be less than we've seen coming out of a recession. And then the chart on the right goes back to 2005, and look at the home starts. We had historically high new home starts back in 2005, and that kind of was dropping going into the recession. And it has started coming back, you know, new houses being built, but it's nowhere near the historical level we had in the early 2000s that we had seen. So when you put all this together, we're believing that this is all good signs that there isn't a bubble, that people can afford the houses they're getting, they can afford the payments they're getting. And we also know that the interest rates are a huge contributor to this. I mean, back in the early 2000s, you were looking at 6 to 8% mortgages. We're down to about 2 and 3%. You can get 2.5% right now on some 10 and 15-year mortgages. 30-year, you're only around 3%. So that's half of the interest rate. And interest is a big portion of any mortgage payment.
Yes, it is.
So all these signs, and I answer the question, no, we don't believe that the housing market is in a bubble and people can continue to have additional discretionary spending for other things moving forward, which will keep the economy rolling. Another thing I wanted to touch on is a change that had just taken place. We just got the consumer price index numbers for August, and they actually dropped for the first time in 8 months. So, you know, we're concerned about inflation. We do have inflation, and we talked about it in our previous webinars, that it is increasing. But if you look at the right side there, my notes, the month-over-month consumer price index data for August was weaker than expected. That's a sign of slowing inflation. Now, it's only 1 month. You know, we've got to watch it moving forward, but the August number was 0.3% increase versus the expectation of a 0.04 increase. And that actually should be 0.4, not 0.4, and lower than the July 0.5 increase. So a little bit of slowing means that, you know, maybe this economy is not overheating, that we're not going to continue that high inflation we've seen in the first half of this year. Also, the year-over-year number showed a 5.3% gain over last year versus last July's gain was about 5.4%. So all these are signs that inflation is here, but that it may be moderating a little bit, which also bodes well for the future, for being able to spend and not have to keep paying higher prices month over month for the things that we buy. I also wanted to bring a slide back that we've shown before that talks about, if inflation is coming, is that going to derail the stock market? And historically, what we've been able to see is that the average real positive returns from the market, we can get a good return as long as interest rates and inflation stay below that 6% rate. If you look at the left-hand side of this chart, when inflation is between 0 and 2%, the market on average has returned the S&P 11.7%. That's a nice return. Okay, inflation between 2 and 4%, 8.5% real rate of return out of the S&P. 4 to 6%, 8.7% historically. It's only when we get greater than 6% do we see that the market doesn't keep pace with inflation. So yes, this is something we're watching, and we will, continue to talk about it and monitor it because it can have an impact. But right now, where we're at, we still see positive growth and real returns on your portfolios moving forward. On the right side, the chart shows when inflation is rising. Historically, the market average is 6.3%. When inflation is falling, it actually more than doubles. So right now we're in a rising rate inflation, so we still see positive returns in the end of this year going into next year.
Brings us to the opportunities then. So we're going to go into where were we from the gross domestic product estimates at the beginning of the year. So early in 2021, we were letting our clients know that the estimates for the 2021 GDP, the gross domestic product growth, was anywhere between 5.5% to 7%. And as Rocky had noted, that has changed a little bit. Nothing really negative, but it has changed a little bit. And you can see in 2022, we were projecting 3.5% to 4.5%. So let's fast forward to today. If you look at this chart, I love this chart. Rocky, again, came up with a great one here, where it shows on the left-hand side the 2020 Q4, 2021 Q1 and 2 numbers. That's the dark blue. That's what's actual numbers right now. That's what we've got in our bank. And then it shows you what the estimates are and how they're anticipating that the GDP is going to slow down, but still, just look at what they're estimating just for the third quarter in 2022 to be at about 3.2. That's still a very healthy number. So whereby before they were anticipating between 5.5% and 7% on the GDP for 2021, they just dropped down the high end of it down to 6.5. And I think that's still very positive because if you think about it, we've got what, 3 months left in the year. The closer you get to the end of the year, the more you can drill down to a more accurate number. So those are very, very healthy numbers. We're feeling good about it. One of the things that did kind of drop it a little bit, all the talk about the Delta variant, like Rocky said before, the tropical storm Ida really did do some damage, and it is interrupting supply chains and could very well increase the supply in an already low inventory environment, which, like you said before, Rocky, that's a little bit inflationary, but nothing that they haven't baked into the numbers.
Yeah, oil prices have jumped up a little bit as a result because the oil comes out of the Gulf and so on and so forth. So
yeah. And then again, 2022 outlook remains strong, although it's starting to get back to normal. And as we get our economy back to normal with everybody working, I don't know if we'll ever get back to the Trump 3.5% unemployment, but if we can get down to 4.5%, 5, that would be much better than where we are today. The other thing that you have to remember when you're comparing numbers is that historically the GDP runs between 2 and 2.5%. Very high, very strong. This is why we think that next year is going to be a pretty positive year for us. You know, when we're looking at these numbers, it's all good news. GDP growth will continue to move, and at some point it will normalize, but not at this point because it's still going strong. When you look at the US sectors, you know what? We still have very strong earnings going on. Even in those areas that have moved very high in the market, the earnings are, I wouldn't say necessarily keeping pace, but it's doing a pretty good job of staying pretty close. When you look at the core equity buys in each one of the sectors, they're pretty high for consumer discretion, financials, information technology, industrial, and healthcare. You look at those average numbers up there and then compare them to the S&P, you could probably see why a lot of our portfolios have these sectors in there, because the money managers are effectively looking for the best opportunities for your portfolios. And, you know, you just have to look at your returns and you see that they're doing an awesome job. Now, let's look at the global market outlook. Nothing's really changed on the expectations here. We will be getting new numbers about mid-October, but for right now, the US large cap stocks are still overweighted. US mid cap and small cap are overweighted. They're strong, even when you compare them to the 20-year average and the near-term forecast. The emerging markets, there's a dichotomy going in there, and I'll talk about that in a slide coming up here. The two areas that are underweighted within most of the portfolios are developed international and investment grade bonds. And we've talked about bonds and the fact that they're just not performing. Again, we're in a secular bear market. You're going to see ebbs and flows, but we're not anticipating a whole lot of growth there. And then the yellow dotted line there, again, is the expected inflation. They always say this, and I firmly believe it. The market is the biggest hedge against inflation. So even if we do have inflation rear its ugly head, the market is still where we're going to want to go for performance. Opportunistic income, it's still very attractive. So again, on the far left side of this chart, you see the investment grade bonds, pre-COVID, pre-crisis, and where we are as of 7/31/2021. And the investment grade bonds have really been chopped down. Even the US high yield is down, much better than the investment grade, but still down. And then you got the senior secured running about the same as the high yield, and the CLO debt, which is a little bit higher than the senior secured loans, but still down from last year. Now, where is the opportunity? Emerging markets, high yield bonds. We're still very close to where we were prior to the crisis hitting, sitting at a healthy 6.5%. So if we're needing to use income for any reason for growth, the emerging markets is where you're going to see some of the positions in the portfolios. Emerging markets, Asia, remain relatively attractive as well. So this chart really shows the global equity markets and the summary score analysis. Now, what's the analysis that we're looking at? Well, CNR does a ranking, and they do it by numbers up to 250. So 0 is the best, 250 is the worst. It's what they call their 4 Ps analysis. And it allows us to see where the potential is down the road. And as you look at this, the two areas that have the most potential, have the lowest 4 P numbers, is emerging markets, Asia, and the US. And you're going to find there's still a heavy weight to the US and more so now in emerging markets. You're going to find that the money managers as well are looking at all this data to determine exactly where is the best way to get the return for their clients. And again, you look at the returns, Rocky, I'm just kind of flabbergasted. This is now 3 years in a row that many, probably most of our clients are in double-digit returns, which is just absolutely phenomenal. Let's go ahead and recap it, Rocky.
Okay.
We have earnings for the S&P 500 setting new records. I mean, every time we come in, that's what we're saying. We pray it keeps going, but we know it's going to end sometime. Asia and Europe recovery progressing, so they're still moving to a positive position. Equity returns remain strong. Longer term returns are expected to moderate, but again, you really have to think about the last 3-year double-digit returns. We're not expecting per se double-digit next year, but I think it'll still be strong. Then you got the jobs and housing continuing to be the tailwinds for this economy. Although there will be some supply disruptions, which will temper the growth a little bit. And then inflation has slowed in August. Still a concern, but not a strong concern, but we're really looking at it as we're looking at where the money managers are investing. And then 500 plus days since the last significant market correction, there will be a pullback. So don't underestimate the fact that it is coming. We are not talking about a recession. We're talking about a 5 to 10, maybe even a 15% pullback in the market. The market has 2 ways to get the PE ratio in line, actually 3 ways to do it. One is an actual recession where you see a major drop in the value of the stocks. We're not expecting that. The other is you have a 5, 10, 15% healthy pullback, and then it takes a few months to get back to even, getting the PE ratio a little bit more back in line. The third way is that the market just walks sideways for several months. That is not an uncommon thing also, but what it does is it gets the earnings for the stock to catch up to the price of the stock. And that in itself allows for the market to move further and continue down that bull run that we've been experiencing. Where does that put us? Well, you know what? In any kind of crisis, we have solutions. In any kind of pullback, we have solutions. In any kind of bull markets, we have solutions. And when you think about our money managers, we take the expertise that they have and we meld that in with advanced planning. And that's what wealth management is, to really take the results that you're getting out of the stock market and enhance them with planning strategies that allow you to keep more in your pocket. And that's really the core of what we do. And that's why we have institutional money managers, which allow us to really take the time with our clients to do the advanced planning to get them where they want to go. You can go directly to Daniel Krug and Associates YouTube channel, or you can go to our website. If you go to mydkna.com, you click on Watch Us, then you've got a drop-down box. You click on YouTube, and what do you get? It takes you straight to the YouTube channel where we have all the videos that we've posted out there over time. And effectively, we have broken down each one of the videos into segments. So if you don't have time to watch all of it, you can watch just part of it.
Yeah, specific subjects.
Absolutely. So it's right there for you. So that kind of takes us to the end at this point. We just want to keep you educated, involved, and make sure that you're going to hit your goals.